Hello. Okay. Perfect. Well, welcome to everyone that is here already. I can see that we've already got a group of you in, which is great. Just looking to see whether there's a few more joining before we kick off. I think it looks like quite a few people here, so we can probably make a start. So as I say, welcome everyone. Thank you for joining us. This is our webinar that we are running to talk about all things inheritance tax, with a key focus on why selling your business can cost you 400k. So I will hand over to Ross to kick off the webinar this evening.
Thank you very much. Hopefully everyone can hear everyone okay there. What I want to start with is just a massive kind of call to action, because absolutely under no illusions whatsoever, HMRC and the government are out to take as much out of you as feasibly possible. We know this, and there's a lot of kind of commentary around. I'm sure everyone has heard, all the kind of stories about exit tax, all the stories of bracing ourselves really for what we're going to get in the budget at the end of the month, which is just inevitably going to be more tax rises. So we all know this is going to happen, but more than that, we've got a situation where the kind of the deck is being stacked against you. So we've got circumstances where lots of rules and kind of complexity is brought into the situation. And today it's just going to highlight and hopefully shine a bit of a light on an emphasis and a need for kind of planning. So the default position in all of this will be, if you do nothing, you will get a huge amount of your lifetime savings taken away from you. But there is a way through it, but you are going to have to take conscious and proactive action. That is going to be my kind of overarching message throughout the session today. So I'm Ross. I'm the chairman of Hive Business. We're a multidisciplinary firm working just for dentists in the UK. We do human tax planning, obviously. We've got a large accountancy division. We help dental practices with their business and their strategy. We've got a marketing agency as well. And I'm also very pleased to invite David Abel, who is our partner IFA firm, who it helps us, in exactly situations like this, planning and preparing for inheritance tax saving. Hi there, David.
Hi, Ross.
Thank you. I also want to introduce my fellow colleague, Simon, who's our tax director at Hive, and who operates all the kind of tax saving strategies and the planning that we do for our clients. Now, there's a very good reason why we've got three of us in the room today. And it is kind of extending this emphasis of you are going to need an overlap of expertise in order to get the best possible outcomes in your planning. Now, whether that's inheritance tax planning or whether it's any other kind of forms of planning, the world has definitely evolved to a situation where you're just going to kind of need more synthesis of good advice. So there's a very good reason we've got three of us. We're all here to talk about it. What the plan today, very roughly, is that Simon's going to give us a bit of a background on inheritance tax, and David is then going to talk about IHT planning elements to it. So if it's okay, Simon, I'll probably let you kind of kick off, but what I do want to talk about just before we kind of get into this, housekeeping, a very important part. So what I want is questions from anyone where possible, please. We've got about an hour, so we'll schedule about 15 minutes for the end, but do pop your questions in the comments if you need to in the meantime. I'll try and cherry pick them if they're very relevant. If not, or if they're too specific or complicated and detailed, we will we'll come back to them at the end of the session, or maybe one-to-one after the session, if that's okay. But we want to hear your kind of perspectives on it. We want to make it as applicable as possible for you. Other thing, I'd just give a generic warning. None of what you see today is tax advice. None of what you see today is investment advice. This is for illustration only. So I'll kindly pass over to Simon. Thank you.
Thanks, Ross. Hi, everybody. So yeah, I'm going to start with just the very basic overviews, just to give a bit of context to the rest of what we'll be talking about this evening. What is inheritance tax? So broadly speaking, inheritance tax is a tax on your estate. That is the assets you own when you die. That includes all of your property, all of your money, all of your possessions, your business assets, all these kinds of things. And thanks to Rachel Reeves, from next April, it will also include your defined contribution pensions. So private pensions, basically, not NHS superannuation pensions, which would apply to a lot of you. It applies to all of your assets. If you're based in the UK, it's all of your assets wherever you are in the world, and wherever those assets are in the world as well, for people who are UK based. But regardless of where you may be based, your UK assets are always subject to UK inheritance tax. And subject to a few things we'll cover in the slides in a moment, it's a 40% tax. So 40% of everything you've spent your life building up can be left as tax for HMRC. We've got a case study a bit later on that will show that actually HMRC can be the biggest benefactor from you passing away rather than perhaps your kids. So that's quite a horrible thing to think about, I think. It's not all bad news. There are some reliefs with inheritance tax. They haven't necessarily grown with the times, but they do still exist, and I'll just talk through them very briefly. So there's an exemption for anything you leave to your spouse. That includes gifts you might make during your life, but also if your assets are left to your spouse in your will when you pass away, there's no inheritance tax. We do have nil rate bands, so that's an amount that can be within your estate that just doesn't get taxed. At the moment, £325,000 per person, initially designed to cover the family home, but with years of inflation and frozen bands, we've had kind of the tax creep. There is now tax on a lot of estates because property values have increased when the nil rate bands haven't.
But probably just to be clear, Simon, there can be multiple scenarios where, like, simplistic version, you're just owning your family home, but you can still be subject to inheritance tax.
Could be, yeah. So what I will say is, if one spouse passes away before the other, these nil rate bands pass over, so the surviving spouse can be left with 650k, but it's not inconceivable that the family home could be worth significantly more from that just because of inflation, particularly if it's been in the family for several years in certain parts of the country. Nothing that anybody has done wrong along the way, you've got an IHT problem. What has been introduced to help combat that is the residence nil rate band, an extra bracket of nil rate band available to a lot of people, but not everybody, designed to lift you up from 325 to 500 or £1 million per couple, only available where your total assets are less than £2 million each, and where the family home is being left to direct descendants. So if you've got no kids, for example, that can't happen. That just won't apply. Other reliefs, the biggest one that's been in the news a lot over the last year, business property relief. Actually, I think farmers made a bigger noise about their version of this than a lot of other people did. But business property relief used to mean that any kind of owner-managed businesses, your dental practices essentially, were not caught by inheritance tax. That is now capped to £1 million per person. Again, not inconceivable that a successful dental practice could be worth more than £2 million, and therefore a husband and wife duo that own it are going to have an inheritance tax problem. That's also probably going to start to erode their nil rate band as well. There's other gifts, there's other exemptions that apply to gifts. So, you can give away a small, kind of largely immaterial amounts each year, up to £3,000 a year, £250 to kind of anyone for anything, just to make sure that kind of ordinary life isn't kind of dragged into inheritance tax in a trivial way that would just be kind of quite annoying for everyone. It's useful to know these things exist, but they're largely immaterial to the overall scope of planning.
And probably if I can just kind of pick on a part there, Simon, the little kind of exemption I can't see on the screen in front of me is your pension asset anymore. So if you've got a defined contribution pension asset, which is, kind of accumulated, that is now within the scope. And, you did mention it earlier, but I think it's this kind of succession or this kind of catalogue of movements that the government have made that have suddenly become an absolutely kind of massive IHT issue, which is kind of why we're all here today. I suppose I'm just kind of emphasising that, before you know it, you've had a left hook, you've had a right jab, you've had a punch to the gut and the stomach, and we're here facing some pretty large numbers, which I think you're going to run through shortly.
Yeah, well, you're right to point the pensions out again, because it is a big deal. You know, we've had years of encouragement from successive governments to contribute to our pensions, build up your pension pot. It's very tax efficient to do that. Okay, tax relief when money goes in, and yes, tax relief when you draw it out, but at least it can go to the next generation tax free if you don't manage to spend it all. You're right with the kind of the left hook, the right jab. It's a kick in the teeth, excuse the pun, that those are now taxed from April next year. I just wanted to kind of talk through a little bit of a case study as to what this can all mean. You know, one of the tagline we put on this webinar is how selling your business can cost you 400K. So let's just imagine a situation where somebody is planning the sale of their dental practice. Now, we know from dealing with hundreds of dentists over the last decade that the common end game for a dentist is a sale of their dental practice. That is almost certainly what most people are planning to do. At the moment, you might have £1 million dental practice, which is covered by the BPR exemption. Business property relief means there's just no IHT. Whilst you're running a business, no inheritance tax on £1 million business, which is fantastic. But actually, what's going to happen once you've sold it? It's not exempt anymore. You no longer own a business which qualifies for BPR relief. You now own £1 million worth of cash. That comes with a £400,000 inheritance tax bill overnight. So it's it's a massive problem, and this is the change that I think perhaps more than the frozen residency bans and the pensions coming in, this cap on business property relief is the change that means so many more people now have an inheritance tax problem, particularly with the trajectory we see dentists on, with a sale of the business at the end rather than passing it down to the next generation. I'm going to hand over.
It might be a bit. Sorry, I was going to say, I don't mean it to be facetious, but it's absolutely not a problem if you choose not to attend to this, and there are multiple ways which Davey's going to go through. You can choose not to, but there will be 400K sucked out of the pot.
Yeah. I think with so many things in tax, there's so many things in life, I suppose. There's choices to make, and that choice may be to take no action at all. You might be completely comfortable with that. You might not want to think about what it actually means to die. It's a big problem in inheritance tax. People don't like thinking about it. But I think you need to be fully informed as to what that's going to mean. So I'll hand over to Dave. Dave will talk through the solution and the way we go about a solution, working together to figure out actually what is the answer for any particular person we're speaking to, because it will be different for everybody.
Thanks, Simon. Thanks for setting the scene. And I think just on that last point, the business property relief, that is often overlooked. And usually people find that out after the fact. So just knowing about that, you can start planning before the sale, which is really important. My name is David Abel. I am the co-owner of Vision Dental Wealth, and we help dentists build a lifestyle and plan for things exactly like this, so we can help them make informed decisions. And what we need to understand while we're planning is very much as a starting point, how much do you need to live the rest of your life? Which is quite a daunting question, because there's a lot of things we can plan for. It might be a holiday home, it might be traveling for that first decade, it could be care for parents. But then there are things we can't plan for as well, like a child's divorce, when we might need an extra war chest, or maybe your own care. So that's very much the starting point. And then in terms of what we can look at for planning for inheritance tax and protecting the family's wealth, there's a few options. So we'd explore life insurance, and I'll touch on that more in the next slide. We'll look at gifting. Gifting's a really important part of this strategy, and having a defined gifting plan is a lot of the route which our clients and partners take. And the available reliefs. We want to maximize every relief we can do. And after we've done all that, we build a plan. Now, there's so many different variables that go into families. No one family is the same. There's loads of things we need to consider. Everyone's different. Everyone's got different children with different money maturity. They might have a vulnerability, meaning that they can't gift direct assets, or it's going to affect estate benefits. They might not trust their children's spouses. There's so many different variables here which we need to factor in, which is why a tailored approach is so important. So these are just a few options that we use as levers to kind of build a strategy with our clients. So life insurance, this is really popular because it means if you're in your 50s or 60s, you may not want to gift assets straight away for some of the reasons I mentioned, but also that transitional stage from when you're pulling an income from a business and then you stop receiving that income and start pulling from your investments can be quite daunting. And it takes a few years to get comfortable, even if you've got assurances from the numbers. That can take some time. So what this does is it buys us time. The other thing it does is it gives liquidity to the family. Let's say there's an estate, the life insurance would pay out if it's been set up properly into a trust, and then the trust would go to the beneficiaries who could pay that inheritance tax liability straight away. And it's even more useful when there's an estate with a lot of the liquid assets in it, because the beneficiaries are already going through a heavily emotional time. You know, the parents have just died, and that's also when mistakes can happen. So it's really useful in that setting as well. Already mentioned about not feeling financially secure enough to gift assets permanently. And there needs to be a distinction between two main types of life insurance. So whole of life will pay out, is guaranteed to pay out on death. You pay your premiums. Let's say we've got £1 million life insurance. You die, it pays out into trust, and your beneficiaries pay the inheritance tax. On the flip side to that, we've got term insurance, where we say a set term of, let's say, 20 years. And I'll give you an example in the case study we'll go through in a minute. And after that 20 years, the policy ceases and it doesn't pay out. So that method is more popular because it's much cheaper. And what we will then align that with is a gifting strategy to reduce your estate. And an incredibly important part of this is the policy should be settled into a trust. If it's not in a trust and you've already got one, what could happen is, let's say you've got an estate of £3 million, that £1 million life cover is paid back directly into the estate and subject to 40% inheritance tax, which is just, you know, that's not what it's intended to do. And it's why making sure you speak to a specialist is so important. So that would be...
Simon, am I right in thinking Simon, we see a lot
please.
of kind of DIY kind of policies undertaken, and I think often it can go a bit wrong, and actually they lose the tax relief as well on them.
Yeah, well, and not just from an inheritance tax point of view as well. We work with a lot of dentists who incorporate, and they kind of have this thing, well, I've sorted my insurances, I'm covered, but actually you might not be now that you've incorporated. Your insurances may no longer really be fit for purpose, and they can so easily be not in trust if you've kind of just bought them online.
Is it easy to get them online, David?
Yeah, well, interestingly, just on that point, it is easy to set them up online. But how insurance works for fees for an advisor is you would pay your premiums, and the insurance company would then pay the advisor commission for setting up the contract. And that's the same if you go direct online. So the only difference is that commission is going to an online provider. So the difference in cost of the insurance would be negligible, if any. So that, you know, it makes sense to speak to an expert.
Thank you. Yeah. It's just interesting. Like, I think there's a belief that it might be kind of more economical, but it sounds like a false economy. Well, it's not even an economy at all. It's just false.
Yeah, exactly. And making sure you've got the, you know, it's aligning with your actual plan is important. You know, people can chuck a life insurance policy up. And I had a client that I spoke to a few years ago that had about £4 million, but it wasn't in trust. And I kind of explained to him, you know, this is a really bad problem. We need to get it sorted out. And we did do, but, you know, it's common. So yeah, life insurance, really important lever that we can use. But gifting, I wanted to talk about the basics. There's a lot more nuance to this, but the real two big gifting strategies that we can look at are gifting to an individual and gifting to a trust. And you might have heard about the 7-year rule and how it applies. So in terms of gifting to an individual, you can gift, let's say, £1 million worth of cash. That there is no limit on that. to, your children. And if you survive 7 years, that money then falls outside your estate. If you die within that 7-year period, that falls back into your estate, and then another calculation has to be done. And there might be some taper relief due. It depends on the size of the gift. Gifting into trust, however, does have a limit on how much you can put in without an immediate tax charge. So you would have to put more than 325,000 in to suffer that tax charge. So let's say we've got a gift of 425,000 we put into trust. We've got 100,000 over that limit. We would pay an immediate tax charge of 20% of that, so £20,000. And that resets every 7 years. So if we settled 325,000 into trust, we waited 7 years till it moved out the estate, we could then settle another 325,000 in. Okay, so they're the two types of gifting that we usually see.
Probably worth emphasising that's just cash as well, because if you gift something other than cash, it triggers a whole load of tax things, doesn't it, Si?
Yeah, it could be, for example, if you're gifting shares, there could be capital gains tax on the shares, depending on, whether it was a gift to an individual or a trust. Also worth noting that gifting to a limited company can trigger that same lifetime charge of tax. So yeah, you've got all the other taxes to worry about in everything you're doing as well. So we do have to be really careful. There's also extra kind of rules about if you gift things that you haven't really gifted, they stay in your estate. So a good example there is saying, hey, I'll tell you what, I'm going to give my kids my house, and they're going to just let me live there, rent free. I get to live in the house, but the kids own it now. So, hey, I don't have to worry anymore after 7 years. That's still yours for inheritance tax purposes. That's still in your estate. You have kept the benefit of that asset, not given away.
I think that's a really good thing. And sorry for kind of interjecting, David, there. Like, I think this is going to happen kind of more and more, and I can almost predict a catalogue of horror stories in 5 or 10 years time where, because people are being subject more and more to this inheritance tax. That's the problem. But it's kind of like a new field, if that makes sense. So, it's not a well-trodden path necessarily for the layman. So you might get these kind of DIY gifts to houses, which of course are just going to be unpicked. And I could just see HMRC kind of rubbing their hands together with glee with some kind of DIY tactics that people have taken, whether it's, the family home or shares or, whatever it might be. I can just predict a kind of, essentially a massive tax yield from this whole area, massive tax yield from people not taking any action, or massive tax yield from people taking some action but doing it DIY. And I know that's not a pretty story, but I can definitely see it happening.
Yeah, it's complicated. We've tried to simplify this, but there's loads of different rules that apply in loads of different scenarios. So again, it just goes back to making sure that you've covered all your bases. And you've got peace of mind that you've got a plan within the confines of the law. So in terms of an actual case study, I've got a client called Dennis, came to us a few years ago. He's actually a client of ours, and he's 70-year-old dentist, divorced, 3 children and two grandchildren. And Simon crunched the numbers with him and helped him with the sale of his business, structuring the business for sale to get the most efficient exit. And he actually exited with 2 million after tax, which meant his total estate was valued at 4 million. And one of the things that he came to me asking is, do I have enough? Have I got enough money to live the lifestyle that I'd like? He knew he had an inheritance tax problem. He just didn't know what it was. And he also wanted to know how much he could give away. He had, mature children that could all manage money, and he just wanted to know how he could help them out and what he felt comfortable, or at least what I thought he could give away. So we started with his existing position, and we looked at his 3 children, and we looked at his estate, and it was clear that each of his children were going to get just over 840,000, but HMRC were going to get just under 1.5 million. And that's money that has already suffered corporation tax, income tax, national insurance, capital gains tax. So much tax has already been taken from that pot. And when we went through this at the table, and I can remember it vividly, he's turned to me and said, we need to do something about this. And that was very much the starting point. And and it always has stuck with me in terms of making sure that everyone understands at least what the problem is. Because if you don't address it and you look at it, this could, if he didn't look at it, this could have spiraled and got even worse. And at the point when, maybe late 80s, this could be a whole lot worse. So it's just about making sure that we're making informed decisions and helping, partnering with our clients to help them make informed decisions. So that's the existing position. And so the starting point, we needed to test financial security. We reviewed everything. We reviewed pensions, investments, property, cash. There were some tweaks we could make to those. Then we cash flow modeled and stress tested his assets. What I mean by that is use some software, put in income, existing assets and spending, and stress tested it using historical data and turbulent market conditions to see in how many scenarios would he have had enough. And he was in a fortunate position of having enough assets to mean he could live that ideal lifestyle comfortably. So we confirmed that by going through the cash flow modeling. We also then discussed how comfortable he was giving away certain parts of his estate, and he had a lot of cash at the end of the sale, so he wanted to give a little bit of that away, but he also wasn't feeling financially secure. I can put the numbers and the cash flow on a board and then in a spreadsheet to make him feel comfortable that he's definitely got enough, but it's definitely an emotional and a peace of mind issue, and that can take time. So that was very much the starting point. And then we together, it's more of a collaboration at this point because there's so many different routes that we can go down. We developed a gifting strategy. So we said, what we're going to do is we're going to gift 300,000 straight away directly to the children, 100,000 to each child. And then we're going to settle 325,000 into a trust for his grandchildren. And what we actually do in this scenario, or did in this scenario, was set up a series of life insurance policies which aligned with the gifts. So I'll explain that at the end of this slide. I'll explain that in a bit more detail. Then we get to year 7, and the first 2 gifts, the gift of 300,000 direct to the children and the gift into trust of 325, have fallen outside of his estate. So now we gift again another 300,000 to the children and another 325 into the trust.
And Dave, that works because survived the death of his spouse essentially. So there's 2 lots. There's 650k he can give every 7 years.
Only 325 because he's divorced in this situation. So because that original gift is at year 0, that falls out of his estate after year 7. If it was partners, it's a really good point. If he was married, then you could do 650,000 each 7 years because you have a 325 allowance.
Was there a reason why he's given them 100k each? Is there any particular reason for that? He just didn't want to give them all to start with.
That's it. He wanted to make sure he had enough, that there was nothing in his life. And remember, he's got his NHS pension coming in, he's got his state pension coming in, so he's got nearly 50 grand in income, and his expenditure was only around 70. But it was still a mindset thing, and it was kind of on his terms. And interestingly, I'll tell you what he actually did after this, because he actually got much more comfortable much quicker than he thought he did. But those were the figures that he felt comfortable with. And then we get to year 14, and this is when Dennis would have been 84 at this stage. Generally, your spending goes down when you're in your mid-80s. You might know with grandparents that they don't spend too much money or don't generally spend too much money. So we thought, well, a big gift here could make a difference to his children. Again, it goes back to making sure you're giving that money when it's going to have the most impact on your kids, and if they're financially secure and mature, rather, that could be before you die, a period of time before you die. Then we look at year 21, and I'll go back to the insurance. So in this scenario, we set up 3 policies: one for 7 years, one for 14, and one for 21. And the idea being, if he died over the 21 years, then the whole insurance tax bill would have been paid, and it gives him plenty of time to understand how much he can give away. Now, the year 14 is really important because that we might have ended up actually giving away more then, but this is just the original plan that we put together. So you can back that with insurance, and because it's term insurance, you know, it was much cheaper than whole of life. I think his premiums were around 1,600 a month to cover that in total. And obviously
we've got someone throwing in a kind of very helpful comment saying Dennis should have less kids. They wouldn't have to give so much away then.
They are an expensive habit.
Yeah, got 3 of them.
But that was the plan. That was the outline. What we said when we sat down together, and if that would have happened, and we would have got to Dennis age 91 at that stage, well, what we've actually said is, or what we've got is 1.8 million being passed directly to the children over that 21-year period of those 3 gifts there. And we've also got 650,000 that's been settled into the trust for the grandchildren. Okay, so that was the plan.
Okay. Term life assurance, it's almost like a bit of a hidden trick, really, isn't it? I don't think a lot of people realize it necessarily kind of exists. And as you were saying, it's much, much cheaper. So it's way more kind of tactical. It's for a specific purpose. Yeah,
definitely. And I think if you're planning and you want to give your assets to the next generation, which is happening with a lot of our clients, the main thing is, when's the time right? If it's too early, it could be a bad result for everyone. You know, it could ruin their lives, and it could, obviously, it's not what you intended for that family wealth. So yeah, it's definitely a strategy which is becoming more and more popular, just because the cost, you know, whole of life generally is. I think the whole of life in that situation would have been around 4,000 a month, whereas the term assurance was just over 1,600. With the term assurance, remember, there's 3 policies there. So after year 7, that would have actually reduced, and then after year 14, that will have reduced again, because the 2 policies would have dropped off. So it's a cost-effective way to do it.
Fantastic.
This was really important.
Ironically, way cheaper than paying HMRC. Sorry.
Well, yeah. Well, technically, you would still be paying them if you died, but you know, it's the insurance company paying them, not you. Is a way to look at it. Yeah. But this is really important, because you can actually, Dennis could see the impact of his gift while he was alive. Usually, someone would live, let's say, to the 90s, the children might be in their late 60s, 70s while they receive that money. But receiving that in your late 30s, 40s, you know, the impact that can have on, because that's when your income squeezed, you know, might be private school fees, kids clubs. That's when your income squeezed. That's when you need the money. You know, when you're in your late 60s, usually you put yourself in a good position. So we got to see that in real time. And he also got to fund his grandchildren's education and creating a living legacy. That money in trust as well, we can do some clever stuff where we pull that money out of an investment, or at least allocate some of that money to the grandchildren to use their tax allowances. And because usually they'll be nil rate taxpayers, it's quite an effective way to draw money from that trust as well. But again, I can go in more detail about that with someone afterwards if they follow up. Were you going to say something there, Si?
No.
So what did he get? Peace of mind. You know, financially, he knew he was okay, but emotionally, he knew he was okay. And we covered his IHT liability for that 21 years. The idea was reducing it during that time. So now the difference for Dennis, well, HMRC gets less of the pie, only 490,000. Again, we kind of touched on this, because of the value of his property, you know, his residence, that would have always given him an inheritance tax issue. I guess the only way potentially around that might have been some equity release, but he didn't want to explore that. And again, he just wanted to have that safety net of his own home. But what it meant is we've got 650,000 in trust, and each of the children get much more larger share, but they also got that much earlier than they would have done. Just to know, I haven't increased the figures with investment returns, but I've also not included inflation, just for the purposes of the illustration, just so it's easier to understand.
Yeah.
But yeah, that's a great result. And again, it was more of a partnership between ourselves and Dennis, making sure that we'd got a plan that he was comfortable with.
Can I pose a question, Dave, if that's all right? So in a scenario where parents are living overseas with the children and the grandchildren in the UK, will their inheritance tax be in the UK, or does the IHT laws of the country overseas apply? I think I might throw that towards Simon. I think that's probably primarily a tax question there, Simon.
Yeah, it's the laws of wherever the deceased is based. So because it's the estate that the tax is applied to.
Okay, thank you. Another question from someone else. Could Dennis have afforded to sell and retire earlier? That's actually kind of a really interesting question, because I know you've had a specific scenario of that recently with a dentist.
Yeah, that's a great question, and yes, most definitely he could have done. And I think that's the beauty of financial planning: knowing your numbers, knowing what's enough, and going to work on your terms. So it may be that you sell your practice, and instead of working, for 2 years, which you plan, you might actually want to work for 4, because you don't have to do it. You enjoy the work, but you're making that decision on your terms. So absolutely, I met Dennis after the sale, which is, is quite common, unfortunately. But if I would have met him, met a lot of my clients kind of 5-10 years before the sale, we can structure everything before then. And then it goes back to informed decisions. You're making a decision on your term. You're running the business because you enjoy it. Or you can wait for the right offer if you know that, let's say, 1.5 million is going to be enough. Interestingly, I've had a client recently where we crunched the numbers. They worked out they had enough, and they decided to sell via management buyout instead of selling to a corporate at a lower sale value, because they'd invested their whole life's work into that practice, and they'd made the culture, and they were just concerned about that culture shift. So we kind of mapped out, well, actually, if we put 60k into your pension for the next kind of 5 years and then you sell it, we've got much more financial stability in that scenario. And you can actually sell it to where you want to sell it. And that really resonated with her. And that is the plan with that client.
Yeah, I think that financial planning exercise is so powerful. It unlocks so much. On the face of it, it's, maybe it's the start of this puzzle is how do we be better off when we die? How do we leave a better legacy? But there's so much about kind of your life locked in, actually what your end goals are and what things look like as well. It's such a powerful tool. Yeah,
and I think when you really dig down what people really want to do, it's surprising how it's different to what they think. They think they need to grow the business. They think they need to do all these things, and I think that's just programmed into a lot of people. So it's just having a good conversation, and you're absolutely right, Simon. It's the best starting point for any planning.
Yeah, I mean, just kind of simplistically on the case study there, that's effectively saved £1 million. HMRC's tax bill has gone down by £1 million there. It might seem really obvious, but that's massive. That's 25% of his estate. Yeah,
it's huge. It's absolutely huge, and there's only that bit left because of his residential property. Ideally, we'd like to remove all of it, but that's just not realistic in some situations. And he was happy. He was happy with that out, which is the main thing.
Yeah, I can definitely see like the real conversations that went on, because you kind of pointed out that there's still a tax bill there, but you're obviously dealing with Dennis, and Dennis didn't want to kind of take those further tactics to kind of change his kind of living situation, or perhaps kind of raise some debt on it to kind of reduce it. So I think it's probably almost kind of emphasizes the philosophy of this whole kind of webinar and us working together. Is it's blending together with kind of the theory of the financial planning, yes, the tax that kind of underpins it, but also the real world as well. Dennis obviously didn't want to kind of take that last step, and that's kind of okay, isn't it?
Well, definitely. And again, he made that choice on his terms, which is the most important thing here. But yeah, I think so. The key takeaways from this is get affordability tested, get your planning sorted before making any gifts. It's not just about family. It's not just about tax, rather. It's about your family, setting your family up properly, your purpose, your life, and making sure you've got peace of mind, not just understanding the numbers on the spreadsheet. Now, this is a really, really useful point. So gifting works best with structure and timing, and it's really it's crucial that you document gifting properly. There's actually a HMRC form where you can do this, and I mention that because a client of mine's parents died recently, and they'd made gifts over the last few decades, and I didn't advise their parents. But they didn't have any documents of this, and the solicitor actually had to look into this and investigate, which wrapped up the costs, which kind of undid a lot of the hard work which was done in that gifting process. So make sure whoever you're dealing with, if you're dealing with a specialist, they will document things properly. But if you're doing any gifting, just make sure it's documented. As mentioned, we use trusts for trust and insurance for flexibility. And once we've gone through this exercise, what I've found and I've seen with my clients is they feel much more secure, and also they feel free to spend more money as well, because we didn't actually touch on spending the money, because that is another option. But having the freedom and feeling like, do you know what, I am going to book that first class flight, or whatever that step is that's going to make an impact on their life. Doing this planning work kind of helps them transition to being able to do that. Wanted to mention family investment companies, and Simon's going to talk about this because they're becoming more and more popular at the moment. So, Si, do you want to just talk about the benefits?
Yeah, of course. Yeah. So many of you may have heard of family investment companies, or FICs, you might hear them referred to as. It's kind of an alternative to a trust, I think, is probably the best way to describe it, Dave, isn't it? It's another vehicle where some of your family's investments can be, but it's a limited company. So it comes with a number of advantages. It's got that similar kind of hallmarks of a trust in terms of your assets being somewhere else, but it's also quite different and used in different circumstances, different sets of rules. Kind of the fundamental difference with it is you keep control. So, broadly speaking, family investment company is a limited company wherein it's, I guess, in its most basic form, the shareholders, who are the owners of the company, are the children, but the parents are the directors of it. They are the people running it. So if you're sat there thinking, great, I've got all this wealth, I'm ready to kind of start planning, but I'm actually not ready to give my kids £1 million. Like there's just going to be 6 Ferraris on the garage and they're going to be always on holiday. Like I'm just not ready for them to take that control. Family investment company is a way around that. So as the directors of the company, you are in charge with what that company does with its money, but it's not your wealth. The value, the ownership of, the estate asset value is with your children already. It's probably more familiar to a lot of people. We're seeing more and more dentists that are operating their businesses through limited companies, not just practices, also associates who, this conversation is very relevant to associates as well, who can earn very well from a very early age. It's going to be something you're more familiar with. Most people will never have dealt with a trust in their life. Most of the people watching this will encounter a limited company.
Yeah,
like
I'd probably kind of chime in there, side. I think we will make the assumption that most people have used or operated a limited company, so there is some kind of familiarity. They are very, very common.
Yeah,
I think if you are watching this and you're a dentist and you're not using a limited company, we would absolutely recommend a serious investigation of it. It's not right for everyone, probably only right for about 95% of people. To harness kind of opportunity and savings there. So if you're not, and you've got kind of questions about a limited company in itself on a very kind of traditional basis, then maybe get in contact about that kind of separately. But the company in itself is a foundation.
Yeah, and I would say, in addition to that, because that's a very good point, if you're not, don't assume the answer is no, because it might be yes if you actually seriously kind of look at it. There are people who have a kind of a legacy arrangement where they think, well, I just can't be a limited company. I checked 10 years ago and I can't. That just might not be the case. So, do get in touch. We'll look at it with you. As I said, though, family investment companies, their purpose is inheritance tax planning as much as it might be income tax planning. So your aim is to have assets growing in value outside of your estate. So you're sat there kind of pulling the strings, trying to make these assets grow in value as much as possible. Maybe it's stocks and shares, maybe it's property, maybe it's whatever it might be that kind of interests you and attracts you to it. But we're having those assets grow in value in the name of your kids and not yourself. Final
is
thing.
There any, sorry, Simon, is there anything that a family investment company can't kind of hold in asset terms? So you have mentioned a kind of a small list there, but I think again, just be careful about thinking it can't do anything.
The only thing I would say it generally can't do is buy the house of anyone kind of connected to it. There's actually, it can even do that, but it causes all sorts of taxes that you probably want to avoid anyway. So kind of anything else that you might want to do with a company, and it's a big part of the limited company strategy, not just family investment companies. There's kind of no point pulling anything out of a company that you don't need to, unless you're spending it on your day-to-day living and enjoying your life. It might be that the company should keep it and do what you plan to do with it anyway, whether that's start that buy-to-let portfolio or whatever.
Well, yeah, I was going to say, like, all these kind of things are fair game. Buy-to-let portfolio, stocks and shares you mentioned, cryptocurrency. I know you do some massive planning for that, but like artwork. Does the list go on?
Yeah, artwork. We've got people who have invested in barrels of whiskey, which in the right circumstances can also be exempt of capital gains tax. It could be in bonds. It could just be cash held in a bank account. Dave, you're the one to give the investment advice, but there's kind of literally nothing that it can't do. There's lots of things you might decide are a terrible thing to do, but you could if you really wanted to do them.
Yeah, and I think just on the investment piece, if you've got an income producing fund within that limited company, any dividends which are paid to the limited company are free of corporation tax. So that's quite a useful thing for you to look at. That's an effective strategy we're seeing with quite a lot of clients that are setting these up.
Free of tax is a series of words I like to hear. So perfect. They're also much more flexible than a trust. So there's loads of different arrangements of, like we kind of said earlier on, David, there's loads of different family structures out there. A family investment company could fit all of them, but I will say, like, it's also not going to be right for everybody. None of these things are going to be right for everybody. It's about there's kind of the three of us working together, along with kind of your legal advisors that will be needed to set these kinds of things up to get the best outcome for the person we're dealing with at that point in time. So I think it's probably a good time, just about on track, to hand over to any other questions we might have had.
I've got one question already, actually. Is a family investment company different to a holding company? And I think I can preempt it's a bit of a yes and a bit of a no.
Yeah, it's kind of just a terminology thing. So when we talk about a family investment company, fundamentally any company is just a company. They're all kind of the same thing. They're a legal entity. They have shareholders and directors, and they do something. They all kind of follow company law. They have corporation tax rules to follow. They're all kind of the same. They're also all kind of different. So we tend to refer to a family investment company as something where it's holding the family's assets. It's about its purpose. But it is also a holding company. A holding company is a company that's designed to own assets rather than run a business. It's kind of bringing the kids in as the shareholders that turns it into a family investment company. So it's really important that they are set up in the right way. They are kind of just different versions of the same thing.
Yeah, I mean, I know, for example, you can probably, I think it's about 30 quid or something, you can buy a company out from, from Companies House, but that's a bit like me buying an implant screw, isn't it? Like I absolutely won't know what to do with that implant screw, but I could buy one. Well, I assume I could buy one. I haven't actually tried before, but I know they're about 30 quid, whatever. So, so you can buy that company for 30 quid, but it's about kind of crafting it for the specific objectives then, whether it's
as we've already mentioned, the kind of the DIY advice is kind of on a hiding to nothing. You could end up in a situation where you've got children with failed marriages and spouses that ex-wives or husbands that steal half the family assets, or you can end up with problems where assets need to be liquidated to pay out divorces, and you might end up with cash kind of stuck, or asset value stuck in a company with no real way to get it out without massive income taxes or a real inflexible way to generate an income from it. There's so many things that can go wrong. There's as many things that can go wrong as can go right if you do it properly.
Yeah.
Is there actually, this is perhaps a helpful kind of topic for the audience. So is there, should everyone look at a family investment company or look at these kind of planning, or is there definitely an element of kind of cost benefit? If you had 100 grand, let's say, in kind of surplus cash, would it be fair to say that's probably not kind of really worth thinking too much about?
I mean, we've kind of already talked about how the family home can easily be the asset that eats your nil rate bands up. So I would say everybody should be thinking about the inheritance tax problem. A family investment company is probably not the right answer if there's only 100K to go in it. Yeah, it's not cheap to set a company up. It's not cheap. It's not cheap to set one up properly. It's not cheap to maintain one. And actually, part of the strategy with a family investment company is that it's intergenerational. This thing may exist for the rest of, for the next decades. There's a cost to maintaining and running that company. You wouldn't do it for 100K.
Yeah, and so they're quite useful in a scenario where you've got some kind of initial cash injection, but if you're going to kind of fill it up more and more over the next kind of decade, that's lovely. That's a perfect scenario, isn't it?
Yeah, the perfect scenario is a pot of cash that can go in. Maybe it's kind of minimum 500K with a plan to continue to grow it. But, that's not a rule, but it might be a nice starting point. Pot of cash to go in.
Yeah.
It can go in relatively tax-free because there's no CGT or anything on cash. Sorry, capital gains tax on cash. The company then starts to make the investments. They start to get bigger and bigger and bigger. That's all in the benefit of the children eventually. That's a kind of perfect scenario.
Cool. I've got a few questions, so I'm going to try and cover off as many as we can now, if that's all right. So I think this will be a simple one. Can an NHS practice be held in a limited company, Simon?
Yes, absolutely. There's lots of people that are kind of believe that they can't. So the contract itself cannot necessarily be automatically moved to a company, but there's ways around that. I've learned actually in the last month or so that some of the banks who had a bit more of a problem with the contract staying out of a company have loosened their restrictions on that, which opens the door for probably a whole other round of people to be starting that process as well. So yeah, absolutely can be.
I think we've heard that unfortunately too many times that my accountant says it's not worthwhile being a limited company, or I can't do it because of an NHS practice. We utilize a dental expert solicitor who's done hundreds of these kind of scenarios, and there's usually kind of a route through is the answer with that.
Yeah, I mean, first port is always say, go and ask the NHS, can we move it? Kind of doesn't really matter what they say, there'll be another way to work it out.
Yeah. Got another question. What are the charges for a family investment company to set up and ongoing?
It will depend on the advice that's needed. I think a family investment company definitely needs the kind of the whole team. There's legal advice required to set it up. There'll be tax advice, and that will depend on what type of assets might be going in and what your plans with it are. There'll be investment advice required for what happens with the cash when it's there. And there might also be kind of trust advice required just to make sure a trust isn't a better thing for you in that circumstances. So it could be anywhere up to about 30K to do it properly, but we're talking about shielding millions of pounds of assets for decades. So it becomes quite cost effective when the numbers are right.
Cool. Sorry, I've got another one for Simon, which I'll follow through. I've got another one for you, David, in the moment, if that's okay. But can a buy-to-let company be used as a family investment company?
Yeah, I presume we're talking about an existing company. So an existing company can be turned into a family investment company. Got to be really careful about whether the children, whether that company has any underlying asset value by the time you factor in mortgages, whether the children are minors or adults, so under 18. That can be. Let's look at it in detail.
Yeah. Or we might want to set up a brand new fresh one.
Or you might just set up a brand new company,
yeah. Dave, what age should inheritance tax planning really start?
I can't say straight away. I guess the answer, and it's a kind of a get out, is it depends. But I think if you're a dentist owning a practice, I think anyone that owns a practice just needs to understand, especially with the changes to business property relief coming up, they just need to understand their position. So it's never really too early, even if it's just you don't have a problem yet.
I think I might kind of answer a slightly different question for the viewer, actually, because I think it will kind of have better context and more helpful. So there's a very good reason why we partnered up with David, who runs an independent financial advisory firm. We want the breadth of the market and the quality of advice that comes with that. There are financial advisors out there that are tied, there are narrow, that's not what we give. That's not what we believe gets best outcomes for our clients. We want to make sure each piece of advice that we're giving to our clients is the best possible for that kind of context. It's inconceivable for me to kind of really believe a scenario where a independent financial advisor, you wouldn't be working with one. Now, that might not be on inheritance tax planning, but it might be on kind of building up the asset portfolio so that there is an inheritance tax problem, if that makes sense. So, if you're running a dental practice, I do truly believe you should have, your position covered with appropriate insurances, because, if you break your hand badly, that might be your income stream kind of turned off for life. Pension advice, there's ways on setting that up kind of tax efficiently. So I think if you've got a good ongoing relationship with the right IFA who's looking at everything for you, I think it will be part of that kind of that kind of relationship, and it will always be a part of the ongoing advice you give them. Is that fair, David?
Yeah, it's a great point. It's similar to accountants as well. A lot of accountants, I'd say 90% are administrators for HMRC. They're not forward planning, that they're not thinking about all of the things we're talking about here. And I'd say it's a similar percentage of advisors are kind of just, I'd say, product led and don't really look at building the plan and focusing on what's important for you and liaising with a team. So for us, that's really important. And our view is we want to have a select number of clients we can have a significant impact on. And initial chat is always free of charge. And if we can't help, we'll definitely be able to add value in that consultation anyway. But it's just asking the question. I think going back to the original question, when do you start planning? I think if you're a business owner, you need to have a conversation.
Great. I've got another question from a good friend and client who's who's posed this, and I know where this is going to go. So, have you ever had a dentist sell up the practice, sell up all their UK assets, liquidate everything, pay the CGT, and move abroad for kind of tax reasons? And I think I'd start. I'm gonna drop you in this, Simon, in a moment, if that's all right. But I think I'd say there's a significant amount of people kind of looking at this and essentially just disenfranchised with the amount of kind of exposure to UK taxation. So I'll come to you for the a little bit of the tax element on it. But I think what I'd say is there's probably two parts to the puzzle. There's definitely jurisdictions overseas that are going to be more favourable. But I think probably also worth pointing out, you've got to live there as well. So I don't have knowledge of all the different kind of tax jurisdictions and what it's actually like to live there, whether, the healthcare system, the economy, the crime rate, all those kind of things that are very relevant to your life. I'd definitely say there's a mood and sentiment of significant number of people thinking about it. What about the tax though, Simon?
The tax, I suppose it's relatively straightforward as long as you're not here. So we have a residency system in the UK. Every country has their own residency system. If you're resident in the UK, you will pay UK tax. You will always pay UK inheritance tax on your assets that are based in the UK. So I think the example you started with, Ross, was everything is sold up and shipped overseas. So that does solve your UK inheritance tax problem. But if you've got property that's still here or company registered over here, then you haven't solved that problem by being overseas. If you come back within a certain amount of time, then anything that happened while you're overseas can end up subject to UK tax when you come back, if you come back too soon as well. So there are a lot of watch outs in there. But if you are genuinely packing up and leaving, then it can work, subject to everything you've just said about having to actually live there.
And that planning can even start pre-move as well. So there's optimizations you can make before a move if someone's decided or got external advice that they want to move to Panama, just for example. That's not advice, but if they wanted to move to Panama, again, it's like this early starting that can help with the tax planning.
I think tax planning for anything can't start too soon. Even when we're talking about the sale of a practice, 5 years runway gives you much more tax options than 12 months runway gives you.
Yeah,
correct.
And if someone moved abroad, they sold it, or before they sold the practice, and they moved abroad and sold the practice while they're abroad, is it they're not allowed to return for residency for 6 years? Is that right? Sorry.
6 years, yeah.
Yeah, and the people that I've known that have done that, none of them have lasted 6 years. They've always come back and paid the tax.
Yeah.
Just because they didn't want to live where they'd moved.
Yeah. Someone described it best to me the other day that, rather than go looking for places where it's tax efficient to be, think about where you actually want to be and work out if it's tax efficient. Because you have to live there. It goes back to a point you made earlier. It's not all about tax. Tax is what we're here to kind of help you solve. But ultimately, we want the best outcome for all of our clients. And that might actually mean paying a bit more tax than some of the alternative options you have. It's about your life as well.
It's the most expensive decision you'll make where you live.
Yeah.
I think we're probably a bit close to the hour now, so unless there's any sort of burning questions there, we've covered a lot of ground there actually. So we've definitely wanted to kind of highlight the I think it's very much that this hasn't been a problem for a certain kind of demographic for a long period of time, including our dentists. But we've had a very quick succession of changes that are meaning it's not just like slightly a problem, it's like significantly a problem now, with inflation kind of eating away or boosting the value of the family home. We've got business property relief that means your practice post sale is taxable. We've got pensions now, which is still causing kind of anger and furor and mayhem across the board, but lots of people have built up their pension pots, and so that's now a massive problem in there. So it's kind of quite helpful in one way that we've had a scenario where it's not been sort of death of a thousand pricks. We've been dropped into the pot of boiling water and we're getting absolutely scolded. We have got to kind of give this attention. At Hive and at Vision, we've decided the best way is to kind of work together with this, and you're going to get those percentage points of advantage and get a much better outcome across the financial planning element, the structuring of it, the planning of it, and the tax relief and possibly the family investment company that kind of underpins it. So yeah, we scratched the surface. The best next step for people if they want to kind of look and attend to this is to book in a free kind of consultation to determine what your kind of scope to inheritance tax might be now, potentially in the future, and your growth plans, and determine best plan moving forward.
Yeah, absolutely. So I would suggest anybody watching this, or if you've got kind of colleagues who could benefit from this advice as well, get in touch. We'll book a free consultation with you. We'll talk to you about your specific circumstances.
Yeah, just to tag on
Thank
to
you very
that,
much.
so tomorrow morning, I'll follow up with everyone, send over the voice recording, and then provide links to both David and Simon's calendar so you can book in those conversations. But if you do want to reach out in the meantime, then absolutely do. It'd be great to hear from you.
Thank you very much, Simon. Thank you very much, David. Thank you very much, Jodie.
Thank
Appreciate
you.
everyone.
Thanks,
Thanks,
everyone.
everyone.
Thanks, everyone.
Thanks.
Have a good night.
Bye.